Everyone on the Zoom. I have to hit my continue. Thanks for coming this evening, and please, if at the end of the session you feel that you've benefited from it, let your friends and colleagues know. Dr. Chu is one of our pulmonary critical care faculty, spends a lot of his time in the ICU, but one of his hobbies is really sort of keeping up to date on a lot of the finances, particularly as it pertains to folks in training as well as young physicians. I believe this is David's third year of doing these presentations. I think everybody that's attended, we've always had excellent feedback. And as you already heard, he tries to keep up to date on these things in his spare time. So David, I'm going to turn it over to you. And again, thank you very much.
All right. Thanks everyone for coming. Again, the main topic for today is going to be student loan management. I'll be monitoring the chat in addition to anything you might have to say. I'll pause a few times during the presentation, but if you have questions along the way, certainly feel free to just type them into the chat. I'll address them as soon as I see them. As we get started here, the first thing I mentioned at the beginning of all these talks is I really have no financial disclosures. Like I don't have like a side business from this at all. I don't make any money regardless of sort of the decisions you make coming from this. I am not a certified financial advisor. And so I can't really make any money off of this. I don't even get like a buy down for my clinical time. That's okay. It's really important that you sort of think about this anytime you're getting advice in the financial realm, because at the end of the day, like the only financial advisors exist is to take your money. And there are good financial advisors out there and there are bad ones. There are a lot more bad ones than there are good ones. But if someone's offering you free advice, there's usually a reason that they're doing it, right? Like everyone wants some compensation for their time. I will tell you that my interest in doing this is because I just have an innate desire to do it. And I really feel like this is something we don't talk about enough in medicine, like just about finance stuff in general. For whatever reason, it seems like it's bad to talk about, which doesn't make a ton of sense. It is not inherently bad to care about your finances. And two, it used to be that we'd get meals with this when this was all in person. So maybe one day we'll be able to get back to that. but anyway, so the other disclaimer I'll put on here is that personal finance is personal, as the name implies. Like a lot of what I'm going to talk about here is hopefully to try to give you information about so that you can make the right decision for your own individual situation, but I can't know that for sure. Certainly I will try to address any specific questions you are willing to bring up. Other than that, like I'll try to provide like the way to kind of approach this in the most optimal way, but depending on your priorities, that may not be the right thing for you, right? Like if the optimal way to deal with your loans is to pay them down as fast as possible, that may not be a realistic option if your priority is being able to raise a family and buy a house, right? Like you need to decide for yourself what your financial priorities are. So the end of this session here, here's what we're hopefully you'll be able to do. If you have federal loans, and I assume probably most of the people in this chat probably do, choose which income-based repayment plan is right for them. Because odds are you're going to want to be on some type of repayment plan for either, regardless of your long-term plans. Describe the criteria for public service loan forgiveness for those of you who are interested, and then for those of you who will ultimately be considering refinancing, what are the risks and benefits of doing so, and how's that compare to PSLF? And hopefully with this information, you'll be able to figure out what your long-term plan is for how you'll manage your loans. And so, it's funny, in some other venues, I'll give this talk and I'll ask like how many people have student loans, and there's like a quarter of the audience that doesn't. I assume everyone that's decided to come to this talk probably has something in the way of student loans that they're dealing with. And it's a huge burden, right? It's like it's this huge number that's kind of hanging over your head. It's hard to really conceptualize like that large amount of money, like just all at once. So I think the first thing that comes up here is like, when should I start making payments? The answer is, if you can afford it, now. Regardless of whether you're going for PSLF or you're going to refinance, making payments now is going to make sense. And if you're thinking about like, okay, what are the effects of if you pay them off now, if you make a few payments now, which aren't really even necessarily going to cover the interest that's accruing, I'll give you a bit of an example. And so if you have say you had $200,000 in loans, and this is how much you'd end up paying under like a repay program. If you have a 3-year training and you make no payments over that 3-year period, and then you pay it off over 10 years after, you're going to pay a total of $338,000. If you make $12,000 in payments now, then the total amount you end up paying later is $20,000. You save about $6,000 by making these small payments up front. And the more money you can put towards your loans right now, the more money you save in the long run. This number goes up even more if you have a longer training period, right? Like, so if you're talking about like 6, so for example, someone like me, 3 years of residency, 3 years of fellowship, all of a sudden that sort of payment period of deciding to not make any payments versus making even like small payments each month towards your loans can make a really big difference in the long run. Another way to kind of think about making payments towards your loans, it's as if you were investing that money in an investment that had a guaranteed rate of return equal to the interest rate on your loans. And so, you know, there aren't a whole lot of investments out there that you're going to be able to get a guaranteed 6.8% annual return on. So if you don't know what else to do with your money and you've got student loans at this rate, probably a good idea to think about at least putting some money toward them, particularly even if your plan is to pay them off in their entirety later, because you will save some money by putting some money toward your loans right now. So how do you fit this into your budget? Well, the answer is you've got to make it part of your budget. And so, you know, I stole this from the Penn State website about like, you know, PGY1 salaries. I think I might be off by a year on this, but so if this is assuming like a single person, like, so your annual take home after taxes is somewhere on the order of $3,800 a month. So if you budget for the big things like rent, groceries, utilities, if you have a car, which you kind of do need around here, disability insurance, and assuming that, you know, you're going to budget something for going out, right? Like you're not just going to work all the time, and you put loans in there, you still potentially have like $1,000 left over, even accounting for paying for student loans under an income-driven repayment plan. So I think it's very reasonable to potentially fit in your budget, at least here at Penn State. But again, like this is making a lot of assumptions. If you're trying to support a family of 4 on a resident salary, this is not a realistic budget, obviously. And so again, it goes back to that personal finances personal thing where you have to figure out sort of what your priorities are, what your expenses are, and how do you fit this into your budget, and if you can fit it into your budget. Because there are certainly situations where even a $338 payment per month may be too much for you to handle. So we're going to focus a lot on federal loans here. And so you've got sort of 3 things to be aware of: deferment and forbearance, income-driven repayment plans, and public service loan forgiveness. I'll talk very briefly just about forbearance and deferment, just so you're aware of those terms. Forbearance basically is you saying that I can't make payments right now. And in order to qualify for forbearance, you have to meet one of these 4 criteria here. Medical internship or residency qualifies you automatically. A monthly payment that would be greater than 20% of your gross income if you were on a standard repayment plan. Most people aren't going to qualify by these 2, but almost everyone is in residency or fellowship is going to qualify by these criteria. So, and if you don't meet these, if you talk to your loan servicer, they may still be willing to grant you forbearance. But basically, if they grant you forbearance either because they have to or because they're willing to, what it means is that you don't have to make any payments on your loans. The downside is that while you're not making payments, your interest is still accruing. And not only is that interest accruing, it's actually capitalized. And what that means is that, so say you owe $200,000 in loans and you accrue $2,000 in interest, the next time that interest is calculated, it's now not just calculated on the $200,000, it's calculated on the $200,000 plus the interest that you've already accrued. So now it's calculated on $202,000 and so on and so forth. So it can rapidly accrue during that period where you're not making any payments. Deferment's a little better if you can qualify for it. In residency, you may qualify for deferment if you need to, where your income is where you're under economic hardship. And this is, if you can do this, it's better than forbearance, because not only are no payments due, but at least your subsidized loans aren't going to accrue interest. Your unsubsidized loans, unfortunately, will, whereas in forbearance, both subsidized and unsubsidized loans would accrue interest and capitalize during that period. The other thing is that during deferment, the interest does not capitalize. So every year when they calculate how much interest your loans are accruing, say that same situation, 200,000 in loans, 2,000 a year in interest, when they calculate the interest next year, it would still be based on the 200,000, not 202,000. And so that's another reason you'd potentially want to go for deferment rather than forbearance, if possible. But and unfortunately, by the criteria, most people don't really qualify for it, but you should be aware that it does exist if something terrible happens. So why do you care about capitalization, right? And so capitalization, interest sort of like being added to the base amount for the next time interest is calculated. This is the difference in how much interest accrues over different periods, assuming no interest capitalization versus the interest capitalizing each year on an interest rate of 6.8%. And you can see the longer that goes on, the wider this difference becomes, where after 7 years, all of a sudden it's a $20,000 difference in the total loan amount that you have to pay back if the interest is just accruing with capitalization versus the interest not being capitalized. So just something to be aware of, because it'll factor in when we talk about income-driven repayment plans and being on a repayment plan at any point in time. So income-driven repayment plans. We're going to focus on that next. So in order to use an income-driven repayment plan, you need federal loans of a certain type. Direct and direct consolidated loans, which for everyone who sort of is in training recently, are probably the type of loans you're going to have. If you have an older type of loan, say you started training like back in like 2000, you went to med school like 2003, 2004, you may have some Stafford loans or Perkin loans or FFEL loans. In order to go under an income-driven repayment plan, that actually needs to be consolidated into a federal direct loan first. If you have those type of loans and you apply to use an income-driven repayment plan, they will direct you to do this automatically. So they'll realize that when you do the application, and then, oh wait, we need to transfer your loans into this different type of repayment plan type of loan. Direct plus loans, ones that you took out and are the guarantor for, can also be paid under an income-driven repayment plan. If you happen to have grad plus loans that were taken out under your parents' name, though, those can't be paid under an income-driven repayment plan. So only loans that are sort of taken out in your name can you use this mechanism. You also have to demonstrate a partial financial hardship. So what that means is that, very specifically, if the payments under the 10-year standard plan are greater than 10 to 15% of your adjusted gross income, and this depends on the specific IDR plan that we're talking about, and we'll get to which goes with which in a second, minus 150% of the poverty level. This is what, if you see the term when you're reading about this discretionary income, this is how they calculate it. Then you have demonstrated a partial financial hardship. So basically, you sort of take that initial, like, okay, I went into repayment, and if I paid this off in 10 years, this is how much I'd have to pay per month. If that amount is greater than 10 to 15% of your adjusted gross income minus 150% of the poverty level, or 10 to 15% of the difference between your adjusted gross income and 150% of the poverty level, then you have a partial financial hardship. It's pretty much a guarantee as a resident or fellow, if you have a substantial loan balance, that you will meet this requirement without breaking a sweat, because your loan balances are really high relative to your income. If you want, you can calculate this out yourself, but NerdWallet has a good calculator. The studentloan.gov website also has a calculator. You can just, if you log in, it'll actually use your actual loan balances to do all the calculations on this for you. But again, most people are going to qualify for a partial financial hardship. The nice thing about being on any income-driven repayment plan is that as long as you're making payments, the interest actually doesn't capitalize. And so while you might be making a payment that's lower than the amount of interest that's accruing, you actually aren't going to, that interest is not going to be added on to the principal amount. And so the amount of interest that accrues over time will be less than if you were just deferring payments entirely. So here's sort of the big table to give you the 30,000-foot view on how to compare the income-driven repayment plans. So there's four main types. There's 2 forms of income-based repayment, depending on when you took out your loans. There's the pay as you earn program, the repay as you earn program, and then the income contingent repayment plan. And so you can kind of see the main things here in terms of the differences between them. And so if you repay and income contingent repayment are the only ones that everyone can use no matter when you took out your loans. You can use payee if you took out a loan after 2007 and you took at least 1 loan after 2011. So everyone who's taken out loans recently should qualify for payee. Those of us like me, since I took out a loan just before this, because I started medical school in 2007, I don't qualify for payee, and I actually have to go to the old IBR plan. For those of you who took out loans even more recently than this, you actually would qualify for the new IBR plan if all of your loans are on or after July 1st of 2014. There's basically very little difference between the payee program and the IBR program, except for their built-in forgiveness, which we'll talk about in a second. So qualification-wise, repay and ICR, everyone can do, and then pay and IBR, and which IBR plan would depend on when you took out your loans. It's important to note that there's a cap on the maximum payment under these plans. This doesn't really matter so much when you're a resident or fellow, because you're never going to get anywhere near this in terms of the payment that's going to be required. But under repay, there is no cap on that on the repayment plan. So if you're still on repay, for example, when you transition from being a resident or fellow to an attending and your salary goes up by 3 or 4 times, that could be a problem, because under this calculation, you actually might end up with a monthly payment that's higher than the original 10-year repayment would be. And so the other benefits, the other things to note about these are there are built-in forgiveness plans. If you're stuck on this plan and you're making payments over, for example, payee 20 years and IBR 25 years, this isn't really the type of repayment that most people should be going for as physicians. If you're still making loan payments by that period, something's gone horribly wrong. Or you're in the situation where you unfortunately had a massive loan balance, like $500,000 in loans, and you didn't qualify for PSLF for whatever reason, then you might be looking at this. But hopefully most people aren't, because the other problem with this is that if it is forgiven, the forgiven amount is taxable. And so what that means is that if you make payments under an IBR plan for 25 years, whatever's left on your loan balance is forgiven, but say it's $100,000 and now you don't have to pay it. In that tax year, it's as if you made another $100,000. And you have to pay taxes on that $100,000. So it's not great. People refer to this as sort of a tax bomb at the end if you're going for this type of forgiveness. So for most physicians, usually that's not the route that you want to take. The pay and IBR plans are nice when you're an attending, because there is a cap on the maximum repayment that you will be required to make. So but when you're a resident, repay may offer you the lowest payment. Pay and IBR will also offer you about the same payment. But the other thing to note about repay is that as the loans accrue interest, as long as you're making payments under the repay program, half of that interest will actually be covered by the government. So say you accrued $22,000 in interest in a year, only $1,000 will actually be added to your balance. So that is another benefit of the repay program, when you're making those minimum payments that aren't even covering the interest that's accruing. ICR really isn't worth talking about. It was the first and only income-driven repayment plan when this first kind of started, but the payment's higher than any other repayment plan, and it really doesn't have any advantages. And so for most people, what I find is, as a resident or fellow, you probably are thinking about repay, except in 1 or 2 circumstances, which we'll get to later, to get the low payment and to get that interest coverage, because that's going to be beneficial for you if you're going to pay off your loans. If you're going for PSLF, does it matter so much? Not really, but it's nice just in case something changes down the line. But before you become an attending, you're going to want to switch to pay or IBR, depending on which ones you qualify for, because you want to have that 10-year cap on your payments inherent to the plan, so you don't end up being forced to make payments that are potentially higher than that once your salary goes up. So that's a lot of information about income-driven repayment plans. So I want to stop there for a second. Are there any questions about that? All right, so hopefully everyone understood, or nobody understood anything, but we'll figure it out later on. Fine. So how do you apply to these if you're not on an income-driven repayment plan yet? Studentaid.ed.gov, repay loans, and you can calculate your estimated loan payments under the studentloans.gov plan if you're not already on one of these, okay? So now here's the big branch point, I think, for most of us in medicine. Should you consider public service loan forgiveness? So the first thing is that you need a job that's eligible for it. The good news is that Penn State qualifies. So while you're here, any payments you make certainly qualify toward public service loan forgiveness. Generally, the things you need to know is we'll talk about 501c3 organization, nonprofit, or working for the government directly. If you're working for either of those, any payments you make while working for them should qualify. If the answer is yes, which right now it will be for all of you, the question is sort of what kind of environment you will be practicing in as an attending. Are you making payments now, right? If you're making payments now, the odds that you're gonna want to go for PSLF are pretty high. But if you decide that no, I'm just going to go into private practice and you don't make any payments to residency, odds are you're going to go toward refinancing them. But if you have a really high loan balance to income ratio, so like your annual salary is less than your loans are 2.5 times more than your salary, you might be considering if you're not going to be eligible for PSLF, you might be considering one of those income-driven repayment plan forms of loan forgiveness. But otherwise, for most other people, if your loan balance is less than 1.5 times your salary, you probably just need to refinance and pay them off as quickly as you can. If you're in that 1.5 to 2.5 range, you kind of have to run the numbers and see, can you afford the monthly payment that would be required to pay off the loans in a timely manner? So if you're thinking about PSLF, these are the things you have to have burned into your head. You have to have the right kind of loan, you have to have the right kind of job, and you have to make 120 on-time payments under an income-driven repayment plan. So the right type of loan, when you go to look at your loans, they have to be federal direct or direct consolidation loans. So either when you took them, they were federal direct loans, or if you had a different type of loan, you consolidated it into a federal direct loan, and that's the loan type that you've been making payments on this entire time. Sometimes some people who've been at this longer have run into the problem that actually they had older type loans, and the way they were able to afford the payments is they used the extended repayment plan where the payments were calculated over 30 years instead of 10 years. If that's how you're making payments, none of those payments count toward PSLF. It has to be under an income-driven repayment plan on the right type of loan. If you did that, you might be able to look into temporary extended PSLF, which we'll get to later, but just if you know that you're in that situation, that'll be more relevant to you down the line. But otherwise, most people hopefully probably, again, if you took out loans more recently, will have federal direct loans. Or if you applied to be under IDR plan, you'll have consolidated them into federal direct loans. The right type of job, this is kind of narrowed over time. They have initially said like, okay, a job that provides a public service, which was very vague. They've been narrowing that and been more specific, but basically the things that have been consistent throughout are if you work for the government, that counts, or if you work for a 501c3 nonprofit organization. So those of you who've been following this maybe saw a few years back, there was a group of lawyers that worked for a nonprofit and they thought they were going to be able to do this. And then the Department of Education turned around and said, no, the organization they worked for was a 501c7, as it turns out. And despite it being a public service organization and a nonprofit, the Department of Education said, no, you don't qualify. The good news is that in healthcare, if you're working for a nonprofit, the vast majority of them are classified as 501c3s. This is actually something you can look up online. You can look up a list of 501c3 organizations and type in the practice the hospital you're working for and see if it's there. Penn State, as I mentioned before, is a 501c3 nonprofit under the tax code, and therefore all the payments you make here qualify. If it's anything outside of 501c3 organization or the government, there's really no guarantee that they're going to certify your employment. So those are the two criteria you should be aware of. And then 120 on-time payments under an income-driven repayment plan. So if you're making payments on anything other than the 4 plans that we talked about previously, none of those payments count. If you're on the extended plan, the extended graduated plan, or you made payments those don't count. If you happen to make this 10-year standard payments though, those do count. And so just be mindful of that as you're trying to count your payments if you happen to make any payments before getting on under an official IDR plan. The difference between this and IDR forgiveness is that the forgiven amount is tax-free. So same example, if at the end of 10 years you have $100,000 left in loans, when that gets forgiven, it's gone. It's ignored for tax purposes. You don't have any additional income according to the federal government that will be taxed. And so that's the other nice thing about this, is that there isn't going to be a tax issue when the amount is forgiven. And so this is a much better type of forgiveness to go for if you qualify. So anyone who's been following this has probably seen all the news about like all these people being denied. 99% of people who've applied for public service loan forgiveness have not gotten it. The problem is that if you look at the history of this, in 2017, when in theory the first few people might qualify and hit that sort of 10-year payment period under an IDR plan, the only income-driven repayment plan until 2009 was income contingent repayment. And as you may have seen, the amount of the payment was higher under that, and people might not have been able to afford that. And so they probably, if they couldn't, they probably used the extended repayment plan, the plan over 30 years. And again, payments made under that plan would not count toward PSLF. Direct loans actually were not the default type of loan you got if you applied for a loan for medical school until 2010. And so it depended on if you happened to go with a loan servicer in the beginning that actually gave you a federal direct loan. It was only in 2010 that all loans you got, federal loans you got, were federal direct loans. And how they track this, the employment certification form, has only been around since 2012. Everyone was asking, myself included, like, hey, we're making these payments. How are you actually going to know that we've been working for the right employer and that we've made these payments? And it's only that the ECF came out in 2012. And so people have only been like filing that since that year. And therefore it's been hard to kind of track payments prior to that, because unfortunately, a lot of the loan servicers that are involved in this, Fed loan servicing being the primary one, kind of suck. So you kind of have to do a lot of bookkeeping yourself, as we'll talk about. And as I mentioned before, the qualifying employment definition is really narrowed over time. It went from being a very broad, provides a public service nonprofit, to really only 2 criteria that they've held to consistently. And so if you look at the total amount in loans that were taken out over different periods, on direct loans on an income-driven repayment plan in billions of the total federal loan portfolio, it's really sort of a small percentage until you get to 2015, 2016, 2017, and it starts to go up from there. And so the expectation, the fact that no one has really qualified actually makes a lot of sense, unfortunately, because there were few people between 2007 and 2010, 2011 that had the right kind of loan, that were on an income-driven repayment plan that they could afford, and actually studiously sort of tracked all of their loan payments. So what I expect is that we should see a pretty big snowball effect, hopefully over the next few years, of more and more people starting to qualify for this. The other concern that gets brought up is that people say they're going to cancel the program. And, it's the federal government. The party in power exchanges hands every 4 years, and it is I think it's a reasonable concern. So I'm going to preface this by saying I'm very clearly not a lawyer. I am a physician first. But if you look at your master promissory note, all of them contain this language that specifically talks about the public service loan forgiveness program. And it says You can consolidate into the direct loan program to take advantage of PSLF. Program provides for the cancellation of the remaining balance due on eligible direct loan program loans after the borrower has made 120 payments on those loans under certain repayment plans while the borrower is employed under certain public service jobs. So it's there, it's in your master promissory note. So if they decide to cancel the program, they're going to have a pretty large lawsuit on their hands for breach of contract. Now, I will say there is a clause in your master promissory note for federal loans that, yes, the terms can be changed if Congress changes them. However, it also says that the terms can only affect loans that are taken out after the law is passed. So if you've already taken out all your loans, it doesn't matter if Congress decides to change the terms of the master promissory note and the contract. They can't retroactively change the terms that exist in your current one. Okay, so since I assume most of you are in training, there may be some medical students here. I know we've been doing a little bit of advertising to them. So if you're a medical student and you're still taking out loans, yes, there is a small possibility that they may change this. For those of you who've already taken out all your loans or in repayment, there is zero possibility that they can change the terms of this contract. If you're really concerned, you could do basically like, okay, instead of putting the money toward the loans, you sort of invest it in the market and you just let it sort of grow. And then if it turns out that things don't work out, you now have this pot of money you can use to pay off your loans. So there is a potential backup plan here if you truly don't think that PSLF is going to work out. But at least in my opinion, after all the research that I've done and sort of following this over the years and seeing sort of the success stories, I do think that this is a real thing. I do think that if you cross your T's and dot your I's correctly, that you should qualify under the terms that are stated. So this is data from this is sort of some of the initial data that came out when people first tried to apply for PSLF. As it turns out, you know, there were a lot of people who this is all the people who requested to have their loans certified as eligible for loan forgiveness. 44% were certified, 32% submitted an employment certification form but didn't actually have qualifying payments, 13% didn't have qualifying loans, and 11% they just say other reasons, which unfortunately doesn't give us a lot of information. But there's a very large swath that like didn't make payments, or they made payments under a non-qualifying plan, or they had the wrong kind of loans. So that already knocked out like 50% of the people who tried to apply. The most common reasons for denial for people who actually applied to PSLF, most of them, there was a discrepancy between what they thought they had made in terms of the number of payments and what the government thought in terms of the number of payments. So they thought there were 120 payments, but the government said no. So that was the biggest reason. Missing information was a big one. It's unclear what. No eligible loans. So again, they've been making payments on their loans, but they've been actually the wrong kind of loans this entire time. They weren't federal direct loans. And then a 5% that were other. And so what can we kind of take home from this? How do you use this information? Well, the first thing is double check the type of loans. That was a big reason people got disqualified. So you really need to make sure that your loans are correct, that they're federal direct loans. And if they're not, they need to be consolidated into federal direct loans. Again, if you're already on an income-driven repayment plan, your loans have already been consolidated into a federal direct loan, but you can look and see how they're called. Make sure that you're working for the right type of employer. Again, right now you are, not a problem. If this is something you're planning to pursue in the future, you need to double check your prospective employer and make sure that they are in fact a 501c3 nonprofit. But again, fortunately, if you work for a hospital, not a nonprofit healthcare system, the vast majority of them are 501c3 organizations. And so in medicine, this actually is relatively easy. You apply, you need to be making payments under an income-driven repayment plan. And during training, you want to start making payments now, right? The payment is based on your income. And so you want to make as many payments as you can while your income is lower, right? So the 10% of your discretionary income is going to be on the order of a few $100s a month. If you have a large loan balance, and it's probable that your 10-year payment probably is on the order of somewhere between $2,000 to $3,000 a month. So you want to make as many payments as you can to maximize the amount of forgiveness you're going to get while you're a resident or fellow. So repay or pay slash income-based repayment, as we talked about before. If you do decide to go with repay, you probably want to think about switching to pay your IBR. Again, that depends on when you took out your loans, just before you become an attending, so that you're capped at that maximum 10-year payment, rather than there being no cap on your payment and potentially having to make payments above that. You may want to consider filing taxes as married filing separately, although this unfortunately gets really complicated. So for those of you who have spouses that are employed and not in medicine, if you file your taxes as married filing jointly, which is the default and you probably should do otherwise, your spousal income is included in your income-driven repayment calculation. So if you make $60,000 as a resident, but your spouse is an attending and they make $200,000, well, then your discretionary payment is going to be based on your income plus theirs, so $260,000 in this situation. Not great. You don't really get much benefit there, right? So you might want to see how your payments change over the year if it just considers your income versus how much more you end up paying in taxes by doing married filing separately. Because unfortunately, all of those tax benefits, all those deductions basically phase out immediately if you try to do married filing separately. So there's a definite tax hit by doing that. And unfortunately, there's no easy way to calculate sort of what the net benefit is here. Unfortunately, our tax system is really needlessly complicated. And so you have to kind of look into this on your own. The one thing is that under repayee, technically you're not supposed to be able to avoid the spousal income calculation. So if you do just think that this is a direction you might go in by trying to do the married filing separately thing, you're going to have to use IBR or pay as your income-driven repayment plan. If your spouse is federal loan, so someone like me, who we both went to medical school and did training at the same time, me and my wife, we both have loans, we both were residents, and we just did married filing jointly. But the payments, yes, they use both of our incomes, but they also use both of our loan balances to figure out the payments that we owe on each of our individual loans. And so because our incomes were the same, the amount that we end up paying on our loans wasn't really affected too much by going married filing jointly throughout all of this. So when it gets to spousal income on this, I'll fully admit there really aren't easy answers here. I can't give you sort of a clear algorithm, but these are the things that you would want to consider. How saving on your payments by filing married filing separately compares to the tax hit that you take by doing so. That's really the thing you have to weigh here if you're needing to go this route. And so if you're considering PSLF, the other thing is documentation. And so submit when they mail you every year saying like, okay, submit recertification of your income to continue to qualify for your income-driven repayment plan. You need to make sure that you do that on time. I made the mistake of not doing that on time my first year out. And what happened was there was a bunch of interest that capitalized. It takes like months for them to actually process it. So if you don't get it in before the deadline, what happens is you get put on an automatic forbearance period, administrative forbearance. Your interest starts to accrue harder, it capitalizes, and so any payments you try to make during that period aren't going to be counted toward PSLF. And so I think I ended up missing, because of these shenanigans, unfortunately, like about a year's worth of payments when I was a resident. So don't do that. You want to just make sure that when you get those notices to submit recertification of your income for your IDR plan every year, that you do it and you do it on time. The second thing is that, now that there's a way to track payments, submit your employment certification form. And actually, the servicer's changing, as I kind of alluded to before, unfortunately, but Fed Loans Act website up to this point, actually, they really fixed a lot of things. And the really nice thing was that it was very clear what payments you had made had qualified for PSLF, right, where they counted or not. But they only update the count of how many payments you've actually made toward PSLF when you submit your employment certification form. They won't update that count again until you submit the employment certification form again. They'll put a thing on there saying, okay, this payment potentially qualifies, but you got to submit an ECF. And that'll tell you at least you're making payments under the right plan and they're the right kind of loan. But it's not until you submit your ECF that they'll actually start updating the count. And this is good to do every year so that you can compare your tracking of how many payments you've made to theirs. You don't want to figure this out like at 120 payments and they're like, actually, no, we think you've only done 80, because it takes months to years in some circumstances to get this stuff fixed, because that loans really sucks. And I'm certain that whatever servicer they're going to go to next isn't going to be much better. So you need to be tracking all of this, and you want to make sure they update what their count, they think their count, your count of the payments are, or their count of the payments are compared to yours, to make sure that they're on track and doing this correctly the whole way, and that you can address it early if there's a discrepancy. And then the final thing is that if there is a discrepancy there, the only ammunition you're going to have is that you have some documentation saying, no, I made a payment during that time under this plan. And the way that you do that is you save all those receipts that you get. So every time you make a payment, you get a notification and a receipt saying like, yes, you made a payment on your loans. You should save all of those, because that is really the only documentation that you have to try to argue if they say, well, our count's different than yours and we're just going to go with our count. You need something to back up your argument. And so that's a lot of work, right? What is it really worth it to go through this? Isn't it easier and faster to pay it off completely? So let's run through an example. So say you have $200,000 in loans, you made $55,000 as a resident, and for the sake of making this calculation easy, we're going to say that that's never changes throughout your residency. And you make $200,000 as an attendant. Your maximum monthly payments under the original 10-year repayment plan on a balance of $200,000 is this, $2,302, because that's what it would take to pay off the loans over 10 years on an interest rate of 6.8%. If you're in training for 6 years and you're under an income-driven repayment plan that's going to make you say that you only have to pay 10% of your discretionary income, that's actually only going to be $307 on a $55,000 salary. If you made 6 years of payments under that and then 4 years of payments under the 10-year payment plan, you end up paying $132,000. And so you actually pay back and then less than you actually took out, and you save a lot. However, if you only had 3 years of residency, you'll pay back a little more than you originally paid, but you probably end up coming out a little bit ahead because not as much interest is accrued, and you aren't paying back that full sort of interest that would have accrued over time either. So there would still be an amount forgiven in this circumstance, it just wouldn't be as much. But if you made no payments during training and instead went to the 10-year repayment plan, even though interest accrued, you would still get some forgiven, but the amount that you would pay would be $276,000. And if you compare that, as we will a little bit later, to how much you might pay under different refinancing situations, at that point, it might actually be better just to refinance your loans and pay them off quickly. So if you're not making payments during training, you really have to kind of compare to how much you're going to pay over 10 years versus how much you would pay by refinancing and trying to pay them off over a shorter period of time, over a 3 or 5 year time frame. So a word about temporary extended public service loan forgiveness. This is for people who tried to apply for PSLF but were denied due to payments not made under a qualifying repayment plan. This still only applies to federal direct loans. Like they have to be, if you have different types of loans, it's not going to help you. So if you have Stafford loans, you have FFEL loans, this still isn't going to save you. So you still need to meet that 10-year requirement, 10 years of full-time employment with a qualified employer, again, 501c3 nonprofit or the government. You made 120 on-time payments during that period. And so the main benefit here is that if you happen to make payments under the wrong plan, you still had the right type of loan, federal direct loan, you still had the right type of employer, but the payments you were making weren't under an income-driven repayment plan. Perhaps you made some of those payments under a graduated or extended repayment plan instead to try to lower the payment. You can use TEPSLF to potentially qualify. There's this weird sort of like 1 year look back where they say, okay, the last year of payments has to be at least as much as you would have paid under a qualifying income-driven repayment plan, which sometimes people don't meet because that 30-year repayment period payment can be really low compared to your income. And so that would be the one caveat if you're potentially going that route. This is not a permanent program, as the name kind of implies, temporary extended. And so there's a limited pot of money to draw from for this. So if you're going to go for this, like this is something you need to go for as soon as possible. That being said, similar to the numbers for PSLF, of the about 55,000 people that applied for TEPSLF, 99% got denied and only 1% got approved. And so what were the reasons for those denials? The vast majority of them hadn't submitted a public service loan forgiveness application. And so this is kind of dumb, but they only allow you to apply for TEPSLF if you actually applied for PSLF and got denied. And so most people probably knew they weren't going to qualify for PSLF, and so they just applied for TEPSLF, but then they were just flat out denied because they didn't apply for PSLF. And that's a real dumb reason, but they require it, so be aware. So if you take that off the table and look at the rest of them, some of the 10% of them hadn't been repaying their loans for 10 years, so that's a problem. 6% of them had missed that 1-year look back requirement, that they actually made payments over the last year that were less than what they would have paid under an income driven repayment plan. So they just got disqualified for that. Some had no qualifying federal loan. So again, wrong kind of loan. Some had the wrong kind of employment. And then the rest were the not adequate information for the most part. And so again, it's not that the program doesn't work. It's just a lot of people sort of miss that you have to fail PSLF first. And then of the people who have met that requirement, a lot of them didn't pay for 10 years, missed that 1-year look back requirement, didn't have the right kind of loan, or weren't working for the right kind of employer for long enough. So again, it goes back to the same things that you need to be looking out for other than that 1-year look back for PSLF. Okay, so that's sort of the overview on public service loan forgiveness. And I know that's a really complex topic, and there are a lot of things that we talked about there. So I want to pause for a second. Are there any questions specific to PSLF? Okay, so again, if you think of stuff along the way, I'm okay. So in addition to the right employer, you have to rectify with student.gov. Can you, so no, so the base, if you're talking about the employment certification, so you have to do two. One is if you're on an income driven repayment plan, every year, you're going to have to resubmit your income information, right? Like they only approve you for a year, and you have to prove every year that your income still meets those partial financial hardship requirements, right? So you need to submit proof of income every year that you still qualify for reduced payments under an income-driven repayment plan. So that's one thing you have to do every year. And that's a must do. There's no getting around that. The other part that I would recommend is that you submit your employment certification form every year. That's not, you don't have to do that, but it's good, again, one, because it makes sure that they update, that they confirm that your employment is certified, that it falls under their requirements, and then they update the number of payments that they are tracking for you, so that you can make sure that your count of the payments you've made is equivalent to the count of payments they think you've made, and that you don't have to contact them and say like, hey, there's a discrepancy here, because again, it takes a long time to get those resolved. Like the last time we certified and there were like 3 or 4 payments off by count on my wife's loans, it took a year to get that fixed. So you want to fix those problems along the way. You don't want to wait till you've hit 120 payments to try to figure out all this stuff. The other thing is that if you do it along the way, you don't have to worry about like trying to track down former employers to get them to fill out an ECF for you, right? Because you've had them fill it out all along the way. So does that clarify that? Okay, good. Other questions? All right, again, I'll keep an eye on the chat. So if you think of anything else, just let me know. So this will sort of get to one of the questions I heard there was earlier about like, you know, when to repayment and how to actually sort of figure out whether you should go for repayment and refinancing versus PSLF. There may be other reasons that you may have to consider recertification, right? If you have loans that will never qualify, so again, parent loans that your parent took out, parent plus loans, any private loans, if you had to supplement your federal loans with privately held loans, your private loans you can't consolidate into federal loans, so you're going to have to pay those off regardless. If you know you're going to go for a private practice job where you know it's not a nonprofit, so the payments you make aren't going to qualify, and so you're just going to have to pay them off. Or if despite everything we've talked about, you still have no faith in the program, which, you know, I still believe it's a real thing and will work out if you do everything right. It just takes the work. You just have to put in the work. But I can't blame people for not having faith in the process. I really can't. If that's where you're at, the answer is going to be refinancing your loans and paying them off as soon as possible. I really would encourage you to, from a like personal finance perspective, to try to pay off your loans as fast as possible and not sort of like expand your lifestyle early on as an attending. Because if you're used to living a resident and you can kind of keep your nose to the grindstone for a bit longer, you can get this burden off and then really sort of be free in terms and really have a lot of options, rather than having to have this sort of as a weight on your back for a long time. So what is refinancing? Well, fundamentally, refinancing is another loan servicer telling you, hey, you have all this debt, but you're paying a really high interest rate on it. So you're paying 6.8%, which is definitely not the prevailing interest rate right now. We'll be willing to take on that debt for you. And instead of making payments to the government, you can make payments to us. And the benefit to you is we're willing to offer you a lower interest rate. And so other companies are willing to take on your debt and offer you a lower interest rate, because that means that they're now getting those interest payments rather than the government. And the way they entice you to do it is by offering you a lower interest rate. And so how do you refinance? You have to have a reasonable credit score, reasonable greater than 680. I mean, if you've like defaulted on multiple credit cards and have other issues in your life, that might be a problem, but most physicians are low risk and hopefully don't have a lot of those issues. And then you sort of shop around. You want to see, since the way they're enticing you is by the interest rate, you want to see which company is going to offer you the lowest interest rate for your loans. You'll have the option between choosing a variable rate versus a fixed rate. If you go with a fixed rate, it'll be a little bit higher, but the rate can't change for the life of the loan. If you go with a variable rate, they can update the rate as often as they like. It'll be stipulated in terms. It might be monthly, it might be bi-monthly, it might be weekly. It depends on the servicer, but they'll have to tell you how often they are allowed to change the rate on your loans. How much they change it will basically be dependent on what the prevailing interest rates are. So there's a little bit of risk, but sometime if you're going to pay it off over a short period, it might not matter so much, as I'll show you. And then the other thing is you choose a term, like how quickly are you planning to pay off your loans? Do you plan to pay them off in 3 years, in 5 years, in 10 years? Because that will also affect the interest rate. The longer the term, the higher the interest rate you're going to be offered, because there's a higher risk that you are not able to make payments. The shorter the term, the lower the interest rate they're going to offer you. And so this was what the numbers looked like, at least from a number of refinancing companies. And I stole this from the White Coat Investor. These numbers have changed a little bit over time, but you can see that compared to the 6.8% interest rate that you're paying with the federal government, they can offer you much, much lower interest rate. And certainly if you took out private loans, almost guaranteed you're going to get a far lower interest rate by refinancing. The problem is not all of these you can't refinance all of these during residency, and for many reasons you may not want to if you have federal loans, and we'll get to that in a little bit. But some companies actually will let you refinance as a resident, and in that case they'll offer you payments during residency that are low enough for you to afford, but they'll tell you like what they're willing to offer you if you decide to go that route. So why refinance? So we'll use again a loan amount of $200,000, and we'll compare different interest rates. So 6.8 being sort of where you start at with federal loans, and then comparing a 1%, 2%, and then like a 2.5%, 2.8% reduction in your interest rate. And we'll also compare like how much interest you pay over different time periods. So if you paid it off over 3 years versus 5 years versus 10 years. So if all you did was keep the 6.8 interest rate, but you decided to pay your loans off of 3 years, you could actually save $55,000 in interest just by paying your loans off faster. And so a large part of the savings can come from just being more aggressive about paying off your loans. But If you change the interest rate up here, then you can see that over 10 years, if you had to make payments over 10 years, you'd end up saving $34,000, $33,000 over a 10-year period by getting a 2.8% lower interest rate. That advantage decreases over shorter time frames because there's just less time for interest to accrue, but it's still substantial. Like even under a 3-year period, comparing 6.8 to 4%, you're saving almost $10,000 by making payments with a lower interest rate over that time period on this balance. So you want to try to get the lowest interest rate you can, because no matter the period you pay it off, you're going to be paying significantly less if you have to pay off over longer periods. But the other part of it is trying to pay off your loans as quickly as possible will also save you a fair bit of money. And so if you think about it, like we talked about, like, okay, 200,000 paying it off over 10 years, if it would be $276,000, as I showed you before. If you refinanced and paid it off over 3 years, you would actually potentially save $64,000 by doing that. So instead, at that point, going for PSLF really wouldn't make any sense, because you'd actually pay back less overall if you're able to make payments over a shorter period at a lower interest rate. And so this is what you really would want to compare if you're starting to make payments as an attending only. Or if you're only making payments during residency for a year or two, and then are looking at 8 or 9 years of payments at that 10-year payment as an attending. Now, the problem with this is that lowering the interest rate is always going to be beneficial in terms of your monthly payment. But if you want to pay off your loans faster, the only way that the math works is that you have to make larger payments. And so the question then becomes, is how much can you fit this into your budget? And this goes back to, what are your priorities? What are your financial goals, right? I would really encourage you to try to pay them off as quickly as possible. But again, whether or not a $5,900 payment each month fits into your budget depends on your individual situation, depends on how much you're making. It depends on what other outlays you have. How many, are you supporting a family of, are you supporting a spouse and 3 kids and trying to pay for daycare and saving for their college and all this other stuff? Like, you have to decide by your priorities what your budget looks like, and would this number actually fit into your budget? And if not, then maybe you might have to look at a 5-year repayment period or even a 10-year repayment period. But you're not going to lose by going for a lower interest rate regardless, if the plan is going to be to pay off your loans anyway. If you wanted to calculate it out for your own situation, what you're looking for is something called an amortization calculator. So if you've, and for those of you who are homeowners and have had to deal with getting a mortgage, it's the same thing. But basically what amortization means is that it's a payment that will pay off the loan and the interest that accrues on it over time, over the time frame that you determine. And so so the way that I calculated all those numbers is I basically threw them into this calculator. I took a loan amount of 200,000. I used different terms, 3 years, 5 years, 10 years, and I used different interest rates. So you can plug in whatever numbers you want here, hit calculate, and it will tell you both the monthly payment that you would have to do to pay off the loan with that interest rate over this time period, but it'll also tell you how much interest you end up paying in that scenario. So you can compare different scenarios this way as you're trying to run the numbers to figure out the best way to handle it for you. There are a few other considerations that you should be aware of before you refinance, though. The first and biggest one is you can't go into deferment. So deferment doesn't exist. And remember how for federal loans, I showed you those criteria, like if you're a resident, medical student or resident, or if it's above 20% of your discretionary income, they have to give you forbearance. With private lenders, they don't have to do that. You have to contact, if you run into a situation where you can't make payments, you just have to call them and be like, I can't make payments, and you have to hope that they're willing to pause your payments for a bit. They are not required to give you forbearance. And so I think as a trainee, it's really good to have that protection in case craziness happens. Payments may also be higher than you can currently afford, right? I don't think any resident is really generally talking about trying to make $2,000 payments on their loans every month. I mean, taking that PGY1 salary again, that would be over half your income. So it's not really realistic to expect that you're going to refinance and start making payments on all of your loans as a resident or fellow. The other thing that gets a little bit tricky and something to be aware of is that for federal loans, if you die or if you are completely and permanently disabled, meaning you can't work at all, your loans are forgiven, they're discharged, right? So your estate, your inheritors aren't going to be told like, hey, these loans need to be dealt with. Or if you're disabled and can't work, you're not going to be told like, hey, these loans still need to be dealt with. However, for private loans, that may not be the case. So if you refinance your federal loans to with a private lender, you have to read the fine print to know whether this is something that would still apply, whether they would be dropped in the event of death or disability, or if they would be assessed against your estate. And so that's just you got to read the fine print kind of thing. You can protect against this with term life insurance and disability insurance, as we'll talk about later on this year. And so if that is your plan and you're refinancing your loans and you have private loans, that should be part of your consideration of how much life insurance, how much disability insurance you need. But that's the reason why, because with a private lender, it may be that someone is going to be still required to pay off your loans in either of those circumstances. So that's sort of my quick overview on refinancing, how to calculate how much you'd pay per month and how much interest you'd pay to be able to compare to how things might look under a PSLF plan. So what questions do you have about refinancing? Okay. So again, hopefully this gives you the tools to be able to compare those two options. Hopefully that answers the question in the beginning about how you would figure out refinancing versus repayment options in PSLF. But if you have any questions about it, please reach out to me. I'm more than happy to discuss this in general. A few words just about sort of some of the stuff that's happened more recently. This is sort of expiring in the near future. Question came up, if you're resident or fellow in Moonlight, should you stay on repay or switch to IBR? Actually doesn't matter, because either way, your moonlighting payments, when you moonlight, that increases your annual salary. And so the next time they do the calculation based off your tax return, your payment would be based on your total income. So it'd be your base income plus your salary. It doesn't matter if you're on repay or payee or IBR, that will still be the case. And so that's, if you're going for PSLF and your plan is to moonlight to kind of supplement your income, it is something to be aware of, that your moonlighting income will affect your IBR payment. And it sucks because like there could be a year where you do a ton of moonlighting and so your income goes up for that year and then the IDR payments calculate on that, but then the year you're making the payments, you're no longer moonlighting. It's usually not, unless you're like doubling your income with moonlighting, which I know people have done. Unless you're doing something like crazy like that, it isn't going to be like a massive change in the amount you have to pay per month. Usually, like if you're only moonlighting here or there and you made a few thousand for the year, it's not going to be a dramatic difference. But be aware, if you're moonlighting a lot and it's not going to be something you're doing all the time, it's going to affect you the next year in terms of how much your IDR payment is going to be. So just be aware of that, that's how moonlighting would affect it. But it doesn't matter which plan it is. So what's the difference when you become an attending? There isn't, it's just now your salary is now like 3 or 4 times higher. And so if you stay with repay, the odds are that the payment that would be calculated under the repay program will be higher than that original 10-year standard repayment that you would have been assessed before you started residency, when your loans first went into repayment. And so the reason to switch from repay, if you're on repay as a resident or fellow, to IBR or payee as an attending, is to cap the maximum payment that they can assess, which goes back to that original 10-year monthly payment, 10-year repayment that you would have been assessed at the beginning before your loan started accruing interest. So the difference is that you're not going to triple or quadruple your income with moonlighting, most likely, as a resident. And so yes, it'll affect your payment, but it's probably not going to be so much that it would be more than the original 10-year payment. Does that answer your question? Okay. So for the CARES Act, things that you should be aware of for those of you who've been making payments under an income-driven repayment plan is that all federal loans were placed into administrative forbearance. And actually, this has been extended. So this was March of 2020. This has been extended now through September of this year. So March of 2020 to September of this year, all federal loans have been in forbearance. interest rates have been set to 0, so no interest is accrued during this period. And the payments are set to 0, but the really great part about this for PSLF is that it still counts as if payments are being made. So if any of you were in the situation where you were defaulted on your loans because you didn't make payments or anything like that, all of that actually got wiped out by this, because everyone has been making on-time payments on their loans through this act, which has been amazing. So the thing to note about this is that, you know, and they updated their website pretty soon afterwards, because people had questions like, okay, we're not making payments, but you're counting these payments. Does this actually count toward PSLF? The answer is yes. These 0 payments are actually counted toward PSLF. And so for those of us going for that, great news, you've now had a 1.5 years of payments that were 0, which is the minimum payment you're ever going to make on your loans. And so, yes, they've confirmed that these count toward PSLF. I submitted my ECF form last year after making a whole bunch of 0 payments, and they counted them appropriately. So I can confirm that this is true. What I would say for I know some people sort of said, no, don't put me into forbearance. I want to still make the minimum payment because I want to make sure PSLF is going to count, that these payments are going to count toward PSLF. If you did that, you actually have the option of contacting Fed Loans and saying like, hey, I want those payments back, and still having those payments and still having those periods count toward PSLF. So there are a few people I know who've done that. I actually did that because my auto debit occurred after March 13th. Before they sort of did the automatic forbearance, and they gave me back the money, and the payment still counts, right? So you might as well get the money back if you can, if you're going for PSLF, because there's no reason for you to make those payments during this period. The other thing I'll sort of throw out there, which I think I mentioned before the recording started, is that unfortunately, or fortunately, depending on how you look at it, Fed Loan Servicing is not renewing their contract with the government for servicing federal loans. There are a number of federal loan servicers out there, but Fed Loan Servicing is the one servicer that has been is the one that they designated if you're making payments under an income-driven repayment plan, and in particular if you're going for PSLF. So maybe the next servicer they choose will be a little bit more competent. I doubt it, but we'll see. But the problem is that poses is that, you know, you have online access to all your information right now and all the payments you made. Nobody really knows what's going to happen in the transition. And so you want to try to make sure you've saved as much information as you can. So like, make sure if you haven't downloaded all those payment receipts, you want to make sure that you have all those saved for your records. You want to make sure that you might consider taking screenshots of their payment count and other things. You probably want to submit your employment certification form soon to make sure that at least like up to this point in the year, things are counted appropriately, because I can only imagine when this transition occurs that there's going to be some ridiculousness that happens. And I will fully admit myself, like in theory, if everything goes well, I should qualify for PSLF in June, and I'm more than happy to share what my experience is once we get there. But I have a real concern around what's going to happen in that transition period and how things are going to be counted and, you know, what happens. And so unfortunately, no one really knows yet. There isn't an answer as to who the new servicer is going to be. So I think the best way to protect yourself is just to make sure that you have everything saved yourself about what's occurred up to this point, that you have your ECF form sort of submitted preemptively to make sure as many payments are counted appropriately, and that's all confirmed before this transition occurs. So unfortunately, a lot of uncertainty when it comes to this, but unfortunately, we're just going to have to kind of see how this plays out. So I'll admit, I have a few sort of practice examples here, but I think probably the best use of the rest of the time is to give you all the opportunity to try to answer any additional questions you might have or anything like that. So I'll kind of open the floor up to everyone and ask sort of what all questions you have at this point.
My only question is, we haven't like gone through income-driven repayment or tried to get set up with PSLF yet, but will this lack of re-signing with the government, like for what Fed Loan, or I forget what the name you said, will that affect someone who hasn't started yet?
So
Like
So
if we're
you
going to
have-
sign up in the next month?
So I'm gonna, let me ask, so I'm gonna assume then you're probably in the situation where you only recently complete, like you and your spouse recently completed medical school, so you haven't started making payments yet?
Yeah, because payments are on hold and they won't let us switch to an income-driven repayment when the payment's on hold.
So you can actually apply, you don't have to, they're required to give you a 6-month deferment period. You don't actually have to take it.
Okay.
You are allowed to apply for an income-driven repayment plan now and start making payments if you want to. And actually for anyone for going for PSLF, I wouldn't take the 6-month period. I would just start making payments as soon as possible. I don't know because of this announcement if they're allowing IDR applications to go through, but in theory they're supposed to. So I would probably, if I were in your situation, I would submit the application.
Okay. Thank you.
You have 2 more questions there, David.
Yep. What happens if you missed a year of IDR recertification but made qualifying payments with employer recertification every year for the last 3 years? So if I'm interpreting that correctly, you were on an IDR plan and you didn't recertify on time, but then the next year you did submit the IDR recertification and then made payments. So the payments during the period where you weren't on an IDR plan officially, that won't count. The only payments that'll count are the ones where you are officially on an IDR plan. And so that's why I emphasized before, like submitting the income-driven repayment plan recertification on time every year, because if you don't, any payments that you make between in that period where you're not on an IDR plan don't actually count. So that's why you want to be sure about like trying to do this on time as much as you can moving forward. And so does that answer that question? Okay. So then the next one, can you explain how the tax bomb works a bit more? Okay. So say that you had like a $600,000 loan balance, right? And you're only making $200,000 a year, which is a thing, unfortunately, I've talked to people who've done this, and we talked about like the best way to handle it. Then actually you might be considering sort of going for that 20 or 25 year IDR forgiveness, the one where if you make payments under that plan for 20 or 25 years, then the rest of the loan amount is forgiven. So say at the end of that, you had we'll say $300,000 left on your loan balance after making payments for 25 years. And you were making them under income-based repayment. So at that point, after your 25th year of payments, that $300,000 balance is wiped away. You're done, right? You don't have to make any more loan payments. It's forgiven. The problem is that for federal tax purposes, it's as if you made another $300,000 that year. So if you're making $200,000 and then that $300,000 is forgiven, for that tax year, it's as if you're actually taxed on $500,000 of income. So that's where the tax bomb comes in, right? If you have a large loan balance that gets forgiven under an IDR plan, and so not public service loan forgiveness, where the forgiven amount is tax-free, it gets completely ignored. Under an income-driven repayment plan forgiveness, that gets added on to your income for the year, and you get taxed on it. And so, as you can imagine, if you're actually making $200,000, but the federal government is taxing you as if you made $500,000, that's a big deal. That's gonna be a lot of money. And so if you're gonna go that route, you have to plan for that tax bill that's going to occur down the line. Does that make more sense? But again, this isn't if you're talking about public service loan forgiveness, you don't have to worry about that. It's same situation, but $300,000 on your balance after 10 years. It's forgiven, and your income for federal tax purposes, you still only made $200,000 that year. So that's another big advantage of PSLF. It's a shorter time frame, and the forgiven amount is tax-free. Okay, so another question. If your loans are currently showing as one discrete loan per year of med school, is there any advantage to consolidating those 4 into 1 loans versus keeping them separate? So it depends. If you started making payments on them all at the same time, and so here's the problem with consolidation. If have you started to make payments on your loans yet? Not yet. Okay. So for you, then the answer is for bookkeeping purposes, it would be easier to just consolidate them under one, into one consolidated loan. It only becomes a problem if you've made payments, if you've already started to make payments, because if you have, once you consolidate your loans, the payments you made before consolidation no longer count. So if you had made like a year's worth of payments and then consolidated those 4 loans into one, for PSLF purposes, it'd be as if you have made 0 payments at that point. So right now, in your situation, if you've not made payments, really, it isn't terrible to do it because there's really no major downside, and it's a little bit easier for bookkeeping purposes. But if you're in the situation where you've already started to make payments, then you probably are just going to have to deal with it moving forward because you don't want to lose the payments that you've made so far. The other thing would be if the loans somehow were at different interest rates. I'm assuming in your situation that probably they're all just 6.8%. Is that correct? They are slightly different rates. So the other thing to know is if you consolidate your loans, the interest rate that would then be assessed would be a weighted average of the individual interest rates. So say you had like $300,000 in loans at 8% and $100,000 in loans at 2%. Then if you consolidate them together, then what you'd end up with is a $400,000 loan that would be 3/4 of 8%, which would be 6, and 1/4 of 2%, which would be 0.5, which would be assessed at an interest rate of 6.5%, right? So it's a weighted average. If you consolidate them, the interest rate that would be assessed would be a weighted average depending on the balance of the loan and the interest on that of each individual loan. So if you happen to have, so potentially in the cards, like your plan is to pay things off entirely, remember, if you consolidate, they're all going to, like, it may be that you might be able to take advantage of, like, if one has a super low interest rate, like 2%, maybe keep that one separate. If the plan's to go for PSLF anyway, maybe it doesn't matter so much. All right, these are really good questions. Any other questions? Any advice about certain companies such as Target and Walmart offering tuition forgiveness benefits? So this is, it's a bit of a hard question for me to answer, if I'm honest. Like, I'm trying to figure out the context of this a bit. Mostly because if someone's in medicine, you're probably not working for Target or Walmart. So I admit I'm a little confused. So I'm just trying to understand.
David, are there some places that they're starting to develop clinics? I had heard that about Target. I wasn't sure about Walmart though.
So that is another way, and I admit I didn't really cover that in the presentation. But when it comes to like your job may offer you loan forgiveness as part of the benefits, and the way that's usually structured is sort of a forgivable loan. And so, for example, if you're being recruited to go somewhere out in the middle of nowhere, one of the ways they might entice you is say, well, we'll give you $100,000 toward your loans. The way that gets often structured is that, like, it's in a way a little bit of it's kind of like refinancing, where they're actually taking on that $100,000 balance and you still owe them the $100,000. But the way they forgive it is that you work for them for a certain period. So they may say, okay, we'll forgive $100,000 of your loans, but you got to work for us for 3 years. And for each year that you work with us, we'll forgive 1/3 of it, right? And so any job can potentially offer something like that. And so if you're going the repayment route and you're planning to refinance and try to pay them off as quickly as possible, it is completely reasonable when you're looking for jobs to say, hey, is it possible that one of the sign-on benefits here could be that you're going to offer me some type of loan forgiveness? And they'll be able to tell you, like, oh, yes, we can do that, and here's how we'd structure it, or, and that isn't something we can really offer to you. But it is, when you're looking for jobs, it is totally reasonable. It is a totally reasonable thing to ask about. All right, So we have a little bit more time, so I'll stay on for a little bit and if there are any other questions.
David, I'm going to sign off, but again, thank you very much. And thanks everybody for coming. Please pass it on. I hope everybody found this very beneficial. I learned a lot just about what's occurred over this pandemic, which you went through. So I may not have the loans, but it was still quite interesting to hear that. So thanks again, David.
All right.